Today, we'll talk about funding a whole life insurance policy with a lump sum of money, and we'll specifically answer the question, is funding a policy with a lump sum in the first year the best option? How we'll answer this question is with a case study of an individual who is just under the age of 60. He's interested in funding his policy with $4,000 per month or $48,000 per year for 7 years, and in the first year, he wants to add a lump sum of $100,000. What we're going to look at specifically are two options and which one is better. We have option A, which involves adding the full lump sum up front, which means his total first year payment will be $148,000 because he's paying the $4,000 per month, which over the course of the first year is 48 grand, plus the $100K on day one. Years 2 through 7 then, he'll continue the $4K per month, which is $48K per year. So that's option A. Option B involves breaking the lump sum up over the first and second year. So here, you'll notice that the first year and second year are identical. The total first year payment will be $98,000. That's because he's paying his $4,000 per month plus a $50K lump sum. He does that in the first year and also in the second year. Now, some say that's a bit longer than I'd like to wait, 24 months. The thing is, you don't have to wait 24 months. If you're funding a lump sum with a life insurance policy over 2 years, it's actually 12 months because the first payment I make on day 0 when I start, and then year 2 begins 12 months later. I might even be able to backdate the policy and get the first 2 payments in over 6 months. So it's an option. I say that because when we compare these two, you might go, oh, I think I like option B. You'll see when I look at the numbers or when I pull up the numbers. Okay, so what we're going to look at are 2 different products with 2 different companies, specifically MassMutual and Guardian. And we'll look at the same comparison, A and B, but you will see different premium to PUA ratios because of the company rules, which I'll explain when we go through the comparison. So let's start with MassMutual. What we have here is their 10-pay product, but only funded for 7 years. So what you'll notice up top, we've got their 10-pay policy. The first year, what is your out-of-pocket? $148,000. Up here is your base premium. It's at 10% of the total payment, which is often as low as we can put it with MassMutual policies. So first year lump sum, $148,000. If we look at this, there's his cash value, just about $130,000. Okay, great. And then after that, he pays $48K per year. After the 7th year, he stops as his out-of-pocket is 0 indefinitely. Look at the year 10 cash value, just to keep this simple. $515,000. Got that? $515,000. Here's the same product, but breaking that lump sum up over 2 years. $98,000, years 1 and 2, and then $48,000, 3 through 7. Here's your premium, $9,800. Why? That's 10% of $98,000. So we set the premium lower. The death benefit, the last example, was much higher than this. It was closer to 1.5. Here you're at $1 million, so you've got a lower death benefit. $86,000 in cash value. Year 10 though, $545,000. You have more money in this option where you got the money in slower. You broke it up over the first and second year. Here's a quick side-by-side. We'll look at this, and then we'll look at the same thing with Guardian, which I would definitely hang on to see that example because Guardian does have a nice feature. You can start with a nice lump sum or a larger lump sum in the first year. So here we go. Here's our MassMutual side-by-side. On the left, we've got the $100K in the first year. So there's your base premium. There's your PUA rider. This also included the cost of the term insurance, which was on the full illustration. I didn't go through the details, but it was there, I promise. And then you have an additional lump sum PUA of another 100 grand. So the total annual funding in the first year, $148,000. What is highlighted in yellow represents the break-even point, which occurs between years 6 and 7. That's a long time for their 10-pay product. That's a long time. This product is one of their strongest products when it comes to cash accumulation, and you can see it grow much, much faster than this. When we compare that, however, to the example on the right, what's the difference here? Lower premium, lower death benefit. Break-even point between years 4 and 5. That's more like it with a MassMutual 10-pay, even starting at age 59. Total out of pocket by the 7th year is identical, $436,000. But which one has more money? The example where we spread it out. All right, let's check this out. So in case you're sitting there with a calculator, here's a nice calculator in Excel that might make things a little bit easier. With the exception of the first year, where I'll have less with this option because I paid in less money, with the exception of the first year, what's the difference? Year 2, you've paid in $196 in both of them. You've got more money. You've got more money. Same product, same company, same dividend, like everything's the same, but we've got more money from start to finish. The reason why is because my death benefit's lower over here and my base premium is also lower. The lower death benefit's really the key. We've got a term insurance rider attached to this policy. The lower death benefit means a lower term cost. We're also funding right up to our MEC limit for 2 years, whereas over here, we're only doing it for 1 year. If you can redline a policy, meaning funding up to the MEC for 2 consecutive years, generally, you're going to see more cash value as a result and an earlier break-even point. It's a great way to maximize the overall value. So we're doing that in this example. So we see more value with the MassMutual policy in the example where we spread it over 2 years, which is pretty cool to see because a lot of times common sense tells us otherwise. If we get money into any account that is producing a return, it'll grow faster. Not necessarily the case with life insurance because it's not considered an account. It's a life insurance product. All right, here is Guardian. So Guardian, the first year, we can still have that 10% minimum premium. So Guardian will let us pay up to 10 times the base premium in PUAs per year. Here, you've got a base premium of $4,800 and $148 going in the first year. The reason why is because their PUA limits in the first year only allow us to illustrate up to 50 times the base premium instead of just 10 times, which means that premium could, in theory, be as low as 2% of the total deposit. So we are taking advantage of their lump sum PUA rule in the first year. We can add a big old dump in and really beefing up that cash value. Check this out. So here's your payment. You're paying $148. You've got $137.5. Do you know what that is in terms of a percentage, cash value percentage of what you paid in? If you don't, and you'd like to know how to calculate it, what you can do is take the cash value, the $137,513, and divide that by your payment of $148. There you go. About 93%. So 93% of your $148,000 payment shows up in cash value. This is for a 59-year-old male. That's his starting age 2. Regular preferred, so second best health class in this particular example. Not the top. You might get that, but time will tell. So that's the lump sum example. So Guardian's favorable in that regard. However, look at the death benefit. You're at $1.8 million. Now let's look at the same thing where we spread it out. So this one will be interesting because same individual, same product, but because we're funding 98 years 1 and 2, we need that higher base premium, $8,900 and change. The reason why is because the most we can illustrate is 10x that in PUAs, beginning the second year. The first year, yeah, you can go up to 50x, but at the same time, we can't do that the second year, which is what's forcing the higher base premium because we've got 98 going in years 1 and 2. So the real question here is, does the policy with the higher base premium outperform the example with a large lump sum and lower base premium? It's interesting. In this case, You'll see that it will. The main reason why is because I have much less term attached and a much lower death benefit. So I'm able to offset the higher costs of the higher premium by having a much lesser death benefit and significantly less term. If it was an apples to apples comparison with the same death benefit, and I looked at a lower and higher premium, the lower premium would win. As confusing as that is, let's look at a side by side, shall we? So same thing here. What do you notice? On the left, what do you got? The example with the minimum premium. 148 in the first year, cash value 137.5. Over here to the right, your minimum premium, about 8,900. A little bit higher than that. I think it was 8,909. The 100K lump sum PUA over the first 2 years. By the 7th year, you've paid 436 into both of them. Cash value by the 7th year, a lot closer than Mass was, wasn't it? Yeah, Mass was 515 to 545. That lower premium helps level the playing field a little bit. Let's look at the long-term comparison. It's cool stuff, isn't it? A lot of times people just are not aware of all the neat things you can do with cash value life insurance. It will never get old. All right. So, cash value difference, more with the example to the far left for the first 6 years. After that, there is a difference in favor of the example that started with the lower death benefit. Now, with all of that said, I will say this. I have seen people look at this via a side-by-side comparison and still elect to go with the large lump sum example. The main reason why is if they're viewing that as an opportunity cost, they like the idea of having access to that capital in the early years and they want to access it through a life insurance policy, and they like the idea of that lower minimum premium. They might fund it longer too. Maybe they keep paying the premium until they're 75 or 80 or something like that. So there are times I've seen that occur where someone prefers that. However, these comparisons do help, especially when you look at the same company, product, everything. We're just maxing them out based on the rules that are available to us with the insurance company. So, which one will he pick? I don't know, because we're still looking at the options. Time shall tell. In any event, I hope that you found this video helpful in terms of starting a policy with a lump sum. If you have questions or would like to see specific examples, feel free to leave a note in the comments. You can DM me. LinkedIn is typically the best platform to reach out. If you'd like to connect with us directly, you can check out our website. There you'll see a ton of free material in terms of video courses. We also have our PDF guides, which are a ton of fun to put together, which provide more written content if you like that form of material. In any event, thanks again so much for watching. I do sincerely appreciate it. And as always, I hope this helps. Thanks again.